Welcome back. You are watching a rolling coverage where we're trying to decode Budget 2024 and draw out with experts the roadmap for India to become a developed economy by 2047 and the immediate target of being a $7 trillion economy by 2030. Joining us now, as told to you earlier, is none other than Sanjeev Sanyal, economist, historian and a member of the Prime Minister's Economic Advisory Council. Thank you so much, sir, for joining us. It's a busy day for you, and I'm sure it has been a very, very fruitful day that you would have had listening to the Finance Minister's speech and all the questions that I'm sure you would have answered already. But please indulge me in asking you some more questions. And I think the first one really is that this time around, the hope was, while the expectation was that there may not be big bang reforms, but a very clear roadmap to the $7 trillion economy, at least, if not to a developed economy by 2047, would be laid out by Finance Minister. But somehow it seemed that it was more of a political manifesto. It seemed like a repetition of Modi's guarantees as opposed to a real economic roadmap.
Well, you have to be clear what this is. This is an interim budget. It's a vote on account. It is primarily a fiscal exercise, and and the Honorable Finance Minister delivered a very short speech signaling the following thing: that this is a government that takes macroeconomic stability seriously. We don't believe this is not a government that believes in providing political sops ahead of an election. So there are no populist freebies that were announced. So the signal is, we believe in stability and in fiscal conservatism. The fiscal deficit is expected to fall from 5.8% to 5.1%. And there are no changes in the taxes. That is basically the first and most important signal that was being given out. Also signaling that there'll be continuity of various things, one being the spending on infrastructure, which has been clearly, again, telegraphed ahead. That's right. This is something this government believes in doing. And so there is a further ramp up of capex in infrastructure.
Absolutely.
And finally, the support for the very poor, whether it's in terms of providing Awas Yojana or extension of the health insurance scheme and other things. So signaling again a continuation of a direct support for the very poor through providing safety nets and so on. So the idea here is not to lay out a grand plan for till 2047. The idea is this is an interim budget, and we, through this process, will signal the key sort of things that this government believes in.
Right.
And when in July it comes back, they will come up with a more clear measures for the next cycle.
All right. So, I want to run some numbers past you, and you being the economist, we would love to get some guidance right here live on the show. If India is to become a $7 trillion economy by 2030, given that in FY23 we closed at a base of about $3.5 trillion, this year we know we are expected to grow at 7.3%. Next year, the data which has come in right now, the estimate suggests that we are looking at a 7% growth. Even if India were to be able to sustain the 7% growth year on year from FY25 onwards to FY30, the simple compound interest formula dishes out a number much lower than $7 trillion. In fact, it rests at about $5.5 trillion or so. As opposed to, if I can just lay the hypothesis here, sir. So, if we were to believe that that India will become a $5 trillion economy by FY28, for which the 7% growth is adding up beautifully, then we are looking at growing for the balance 2 years at a significantly high 19% growth rate. Rather, on the other hand, if India were to target a double-digit growth of, let's say, 7.37% this year and next year, followed by an 11-11-12-12-12 cycle, then we are hitting the $7 trillion mark. Is that a fundamental problem with the calculation, or do you think this double-digit growth is achievable?
No, your calculations are incorrect. So let me explain.
Sure.
You have to understand that when you're talking about the number that you just used of 7% growth and so on, these are constant prices in a particular from a particular year. So
Okay.
whatever your base year is, these are what is called real or constant price GDP growth rates.
Right.
The target that you are mentioning is a nominal target at
Right.
current prices, not at
That's right.
fixed prices. So what you have to add in back here is inflation.
Inflation.
So yes, so when you say, let's say you have 7% GDP growth and let's say 4% inflation, so you are actually compounding at 11%.
All right.
And then you have to, of course, because it's done in dollars, you have to then have some estimate of what you think the exchange rate will be.
Right.
Now, the exchange rate is broadly stable now. Let's, I mean, it may, whatever you think is a depreciating rate or appreciation, you can work it out. But let's say it's stable, then you are compounding at least, even if you have 7% GDP growth rate and 4% inflation,
Yeah.
then at least at 11% every year.
All right.
And that is how those calculations are arrived at. So be very careful just using the constant price GDP growth rate.
Fair enough. And what do you think, in your estimation, is actually going to be better for India in the long term? The rupee appreciating or the rupee depreciating? Because the depreciating rupee is great for exports, but an appreciating rupee is going to keep our import bills high. So what do you think India should really gun for going forward when it comes to exchange rates?
So we have a very well-established system, which the Reserve Bank has been now running for some time. And it is basically what we do is we lean against the wind. So supposing there's a lot of pressure for the rupee to depreciate, then we use up our foreign exchange reserves. We have quite a lot of it, about
Right.
$620 billion of it.
That's right.
And then when under pressure to appreciate, we accumulate reserves.
Okay.
So basically what we do is we allow the rupee to find its own level, but don't allow huge volatility. I think it's a good approach to take because it allows the rupee to find its true value, but at the same time, it doesn't allow the rupee to sort of go up or down too much because that is disruptive.
All right.
So I think that is what we will continue doing. Now, what is happening, however, that over time, the rupee is becoming a much more credible currency. We have anchored our inflation. Our exports, our share of world exports is growing, although the world economy is not growing very fast right now, but nevertheless, our share of it is rising. And we are also taking various measures in order to harden the Indian currency as well, allowing it to be used widely and so on. All of this means that over time, I expect that the pace with which the rupee has depreciated, the pace over time, I think that will slow and maybe the rupee will become a reasonably stable currency vis-a-vis the US dollar.
Okay.
So that's where I think it will be. But that is not because we are doing anything actively.
Okay.
It's just that is where the natural price of the rupee will kind of stabilize.
Right. Before my colleague Shweta Kothari jumps in, I have one more question for you, Mr. Sanjeev Sanyal, and that is about the fiscal deficit. And the fiscal deficit, even though it has been reduced marginally in this financial year, expected to close at 5.8%, and the next financial year is likely to be 5.1, followed by 4.5, we still seem to be a fairly long distance away from the 3%, which needs to be the long-term target of the economy. There hasn't been any mention of how India can reach that 3% milestone, and it still seems fairly elusive. So do we have the kind of debt financing instruments, and are we good to leverage ourselves to reach that 3%? And until we reach that 3%, are we good financially?
We are more than comfortable on that front. As I said, 5.8% is what the Finance Minister announced is the deficit we will have in this financial year.
That's right.
My own calculations, by the way, suggest that we'll do better than that, but that
Okay.
Based on the data up to December, but never mind. Let's take the Finance Minister's number at 5.8. And then it comes down to 5.1 and then finally 4.5. This is a very responsible pace of consolidation. There is absolutely no reason to do it any faster because our borrowing is under no pressure at all. The borrowing number that has been announced, I think the bond markets will be quite happy with it. And in fact, if anything, our cost of borrowing will decline over time as we consolidate.
Okay.
There's more than adequate appetite for these bonds in the financial system, our own financial system. And now increasingly global investors are also beginning to invest into it. In fact, as we become part of the global bond indices, more and more people buy them.
Right.
So I think financing ourselves is not an issue at all.
All right, Mr. Sanjeev Sanyal, Shweta Kothari this side. So, my question to you, is a continuation to what my colleague asked, and that is with regard to the fiscal consolidation part. Now, the borrowing figure has come down to about 28% as it was announced in the budget. However, debt to GDP ratio, as has been reported in many newspapers, also in an IMF report that was published early last year, is about 57%. Our own estimate is that it should come down to about 40%. Do you agree with those numbers? Number one. Number two, what is the path ahead to reduce that, that debt burden on Indian economy?
So as I said, the debt to GDP ratio is declining. I mean, obviously it spiked up during COVID for obvious reasons. But since then it has been declining. If you look at our peers around the world, other economies around the world, you'll see they are far more indebted. And given that their economies are not growing anywhere as fast as our economy is growing, they have much bigger problems in terms of debt sustainability. India's debt sustainability is not a serious issue. Our debt to GDP ratio is declining because we are borrowing at a much lower nominal interest rate than our nominal GDP growth rate. So, and that interest rate is in fact over time likely to reduce. So the gap between our nominal growth rate, which I explained earlier, is real GDP growth plus inflation. So it's running at about 11-12%. So that is much higher than our borrowing cost, which is running around 7% and will probably decline towards 6% over time. So that gap is more than adequate to bring down our debt to GDP ratio, especially if our primary deficit is also declining at the same time.
All right. And one of the biggest announcements, of course, that was made was with respect to the capital expenditure, CAPEX, which will now be to the point of 11 lakh crore rupees, up about 11% from last year's allocation. My question to you is that, so in the last 1 year, we've had discussions about how government spending is on the rise while private sector does not seem to be participating as much. What sort of momentum have we seen from the private sector, and when can we see that double engine finally being fired up with public spending on one side and perhaps private sector also spending on the rare side?
So this government has had a commitment to infrastructure spending for some time. So this is not new, and all that was announced is a continuation of that since it's when. So, I mean, what the Honorable Finance Minister is signaling is that, look, we are committed to better, bigger infrastructure, and this government has already built quite a lot of it, and we will continue building more of it. In fact, it's all visible to you. In fact, the world's largest concentration of cranes in the world is perhaps right now in Mumbai. So, this is visible infrastructure, and we will build more of it. So that's basically the signal. Now, as far as what was the question now?
So the question was about private sector participating.
Private
investments.
Private investments. First of all, this emphasis on public infrastructure and investment is not some substitute for private investment. It is not. We never see it as a Keynesian sort of pumping of demand, which is trying to sort of compensate for private investment. We are unapologetically a supply-side driven economy, and we believe in building this infrastructure irrespective of what the private sector is doing. Now, having said that, the private sector did go through, investment did go through a prolonged drought, but that has now more than come to an end. I don't know why this is still a part of the debate. Corporate India is in rude health. Our banks are in rude health. Many of them are raising money in the capital markets, and virtually any company you talk to now has expansion plans. Many of them are already implementing those expansion plans. So I am not sure why this discussion on, private sector not investing? I mean, they are investing quite clearly.
Okay, I want to draw your attention now to the tax collection and the tax buoyancy. Till last year, we were seeing that the direct taxes and indirect taxes together were contributing about 15% each. In the new estimates presented by Finance Minister today, we are looking at tax buoyancy to go up to about 18% and 19% each. What do you think is going to lead to greater tax collection, especially on the back of already record high GST collections that we've seen, and the fact that rural demand continues to be tepid and job losses, even though government data states otherwise, but CMIE report suggests that the rate of unemployment in rural India is a little higher than what it is in urban India. So there is of course some data mismatch, but that notwithstanding, how does the government go after greater tax buoyancy to a point where both direct and indirect continue to contribute that much higher?
So I'll ignore the CMI data. I mean, I have long argued that it is a poor reflection of anything. I mean, even when the numbers dramatically improve, I don't use it. So it's not that I have a problem with it just because right now it shows something. I don't use it under any circumstance. What we can see is that clearly tax collections are buoyant. What is that a reflection of? Well, the obvious thing is that demand for products must be strong. Otherwise, how would you have GST collections being buoyant if people were not buying things? So I actually do not subscribe to this view that demand is slowing down, particularly in rural areas. I think demand is reasonably
how do we reconcile the data? Even if we were to ignore the CMI data, how do we reconcile the fact that out of the 7.8 crore Indians who have filed income taxes, a big chunk of that continues to be nil tax returns? So, which pretty much states that their present income, which they are drawing per annum, is not even enough to fall in the tax slab. So, is there no need for reconciliation of data?
So, in fact, this is a problem of tax compliance, which we have had for a very long time. So one of the reasons the tax collections on the direct side is improving, the GST is different, but on the direct side, you are seeing improved collections is because of increased compliance. There is no doubt about that. And this compliance problem has to be, over time be solved. But the fact that more and more people are coming in and at least registering themselves is a good sign. As the numbers that you have put on, the filings have at least gone up dramatically, and in fact, even those who are giving declared and even paying taxes is going up in numbers. It is a low number; it should be higher, but it used to be even lower in the past. So while we would like to do better, what you are seeing is a dramatic improvement on what things used to be.
Okay. Since we are on the matter of jobs, Mr. Sanyal, I want to pick your brains on how far we have come when it comes to manufacturing. The PLI in the 14 sectors that was opened up for to the tune of 1.97 lakh crore rupees has only shown investments to the tune of about 1 lakh crore rupees. Now, is that money enough? Number one. Number two, do you see manufacturing actually picking up in most sectors? Because we have only seen electronics, smartphones, IT hardware, and to some extent auto companies actually enjoying those PLI benefits. Are you also looking at other sectors participating?
So the way the PLI scheme was set up was to encourage dramatic scaling up of certain sectors that we wanted to target. Now, it was understood right in the beginning that not every one of them would work, but that is okay in some ways because the PLI is set up as an ex post support. So for whatever reason, if a PLI scheme does not work, the government hasn't actually spent any money on it because, so in that sense, if a PLI scheme doesn't work, you tweak it to see if it works. If even after that it doesn't work, you can put it aside and try another sector that you want. Because the important thing here is that if a PLI is not working, the government is not spending. So it is not like the government has ended up using up its resources to support something and it didn't work. You try a bunch, some work, some don't. And as you yourself mentioned, it is clearly working in electronic type things, probably also a bit in pharmaceuticals and a couple of other places. But there are areas where they have not been successful. Those areas may need other ways of supporting them. But meanwhile, the government has not tied up its resources in those sectors.
All right, that's all we have time for. Sanjeev Sanyal, as always, sir, thank you so much for joining us right here on News 9 Live. Pleasure talking to you, and we hope to keep having you back with us, Shweta. Thank you.
Thank you very much, Mr. Sanyal.